me if you need me. And I'll just bring that back down.
Thank you.
Okay.
Okay, who wants to run this meeting? Just me?
You can call the meeting to order.
I'll call the meeting to order. Why don't we take roll? I'm William Pearlstein.
Jim Lettle.
Bert Dukes, Finance Director.
I need for the microphones to be closer.
Okay. Bert Dukes, City's Finance Director. And Jeff Kowalczyk from the auditing firm of Barber Kane Thornton is in attendance and will present the report.
Jim Horty, do you want to at least announce yourself?
Here with them.
Yes.
Yeah, we can hear. Jim Horty is on by audio, is not able to be present in the commissioner's room, so we do have a quorum, and we'll be able to vote at once we've had our review, and Jim is certainly welcome to participate. Will not be able to vote, as I understand the rules of that the commissioners have set. Okay, Bert, do you want to begin?
Yeah, I'm going to introduce Jeff, and Jeff is going to go through the audit report, and I'll support him with whatever questions or information are required or needed. So, Jeff, you want to?
Sure. And Mr. Horty, if you're having difficulty hearing me, please let me know. We can move the phone around. But thank you so much for having me on site today to discuss the results of our audit for the year ended March 31st, 2023. I'm pleased to let you know that based on our auditing of the financial statements and the underlying processes, we are issuing an unmodified, also known as a clean audit opinion on your financial statements, as well as in accordance with the Government Auditing Standards Yellow Book guidance, a clean report on internal control over financial reporting. This year, unlike recent years, you were under the $750,000 threshold and therefore were not subject to the Federal Single Audit Act. So you will not see a single audit supplement within the financial document. But we remain vigilant, as does your accounting team throughout the year, for any federal origination or pass-through grants that may require special treatment. The structure of the document in front of you is consistent with what you've seen in recent years. The biggest change for your organization this year was there was a new Government Accounting Standards Board, GASB, statement required to be implemented on lease accounting. So effective this year, whether you have an operating lease or a finance lease, which are the two primary categories of leases based on whether or not they are truly a temporary lease or closer to a finance substantive purchase that's just dressed up as a lease. There used to be two completely separate sets of accounting for them, and now they've been largely converged. So for all leases that are greater than 1 year in length, you're required to reflect a lease liability on the financial statements, as well as an intangible right of use lease asset, which is amortized over the life of the lease.
Is there any difference between the FASB and the GASB on this?
There are some technical implementation differences, but the bulk, it's largely consistent in that you now have an asset and a liability. The GASB statement treats it much more like an item of debt, where we recognize a principal and interest component of the lease, whereas under the FASB guidance, it's for an operating lease, you have sort of a single lease cost that's amortized. So the disclosures look different, but the impact on the financial statements is relatively consistent between the government sector and the sort of private sector / nonprofit world. I will let you know, because there is both an asset and a liability, the impact on the bottom line is negligible. Sometimes there's little differences based on the way the lease assets are amortized compared to the liability being reduced, but they are usually hundreds or a couple $1,000s over the life of an average lease. And for your organization, your leased assets are at about $500,000 and are primarily leased vehicles. So any impact is immaterial and not anticipated to change in future years. Pages 1 through 4 of the document are our independent auditor's report, which, like I said, identifies that we're issuing an unmodified or clean audit opinion, and also references our yellow book audit on internal controls over financial reporting in accordance with government accounting standards. That actual report is at the back of the document, but it is referenced in our main report. After that, beginning on page 5, is management's discussion and analysis, which provides a narrative overview of the financial results for the year and attempts to put them in context by comparing with prior years and also providing information about what caused variances that you may see in the financial numbers. This is always the place I like to recommend people look first because it's high level, but it's also written in a welcoming way that for anybody outside this room, anybody that might not be a financial expert, it's sort of a foot in the door to the financial results. But then beginning on page 9.
Just got a question for you,
Ye-
Bert. The pension, is there any talk about keeping it or phasing it out?
Okay. All
Is
right.
the state police pension plan or a different plan?
Well, I think what you're talking about is the city's plan for the employees, which is it's not a defined benefit plan, it's a defined contribution plan. So Empower, you may have heard of them, they were kind of new to me. Mass Mutual used to be the manager, and now Empower's taken them over or bought their assets, and everything's pretty much the same. I'm sure that there's no plan to do away with it. The city's not considering a defined benefit plan. Nobody's considering defined benefit plans going forward. But the state police plan that we participate in, that is a defined benefit plan. And I don't know of any changes there. It's well-funded. Last year, I think it was over 100% funded, so.
Yeah, and our percentage in there is minuscule, if I recall correctly.
Yes.
I think it's well under 1%, if I recall correctly, in terms of what our overall responsibility there.
That's correct. And that plan, unlike some other plans within Delaware and other states, is very well funded. And actually, that's a great segue into page 19, which is your entity-wide statement of net position.
Before we do that, can we look
Yeah.
at page 10?
Yeah, absolutely.
Because I don't know if you're planning to go in order or not, but the top paragraph on page 10, the
Yes.
percentages don't foot, as I read it.
Okay, I can take a look at that.
I just simply added them up, and they don't appear to be close to 100%. Maybe I may be misreading it, but
Sure.
we had 53%, and then we had 71%, so that's, then we had 3.3%. So
Sure. Yeah, I think I'll take a look at that. I think it might be 71% of the remaining 47%, like that kind of thing, where it's just not worded quite right. So
Okay,
we
thank
can, before issuing the final document, we'll make sure that that makes sense.
Okay, thank you.
All right. Yeah, I was planning to jump to the statement of net position next, but are there any other questions on the management's discussion and analysis?
Actually, the question really for Bert, with the increasing amount of remote working, have we actually looked to see what the overall effective population is here off-season? Either from looking at water usage or garbage tonnage and all that.
Yeah, last year, I mean, not this, like FY '22, you notice that there were more people down here during COVID and before staying longer. The rental people were renting more off-season. It seemed like this year there's less of that. And as far as seeing any real movement in the flows of water, sewer, didn't really have any big indication. The big change in water and sewer was the addition of the West Rehoboth flow that was coming into Rehoboth. And so the impact of that is the city will have to share less of the cost of operating O&M costs because Dewey's using more of them. Dewey is, and the West Rehoboth are all one piece. So, in answer to your question, the remote working, I think it's kind of slowed down to a degree. And I use that, basing that primarily on the what I'm hearing about realtors and in the rentals and everything and off-season occupancy, but the flows don't really indicate any tremendous movement.
Okay, thank you.
Right. So on page 19, the statement of net position, you will see that as of March 31st, 2023, the total assets and other deferred outflows of resources of the city are about 155 million, compared to 140 million as of the same time in the prior year. The biggest changes there, probably the single biggest change was the increase in capital assets net of depreciation, which we will talk a little more about as we get especially into the sewer fund and the projects going on in that area. On the liability side, you did see an increase, not quite as much of an increase, but an increase from about 67 to 70 million. It's because there were some draws on debt as a result of that building, but also you're at the point where you are starting to pay off some of the sewer fund debt items from prior years. So we are seeing that level off a little.
Jeff, going back one page on page 18, the second paragraph under economic factors.
Yes.
You point out our very high dependency on seasonal usage here. And, from a, considering the potential risks, and this is really, my question to you is, what do other resort towns do to reduce their dependency somewhat to these effectively variable sources of revenue? And then directing to Bert, simply a question for the city administration of recognizing that our costs are largely fixed. There's not, other than seasonal police and things like that, there's not much that we vary. And yet, as you point out on page 18, in the event of an awful summer weather season, we're in a situation where such a large percentage of our revenues are coming from parking and issues like that are totally dependent on people coming.
Yeah.
So the immediate question to you, Jeff, is what do other places, either in Delaware or elsewhere on the Atlantic shore, do that may help spread their sources of revenue more than we've done?
Yeah, so the truth is you can only spread them so much, and I do think the city has made efforts to balance out, recognizing that it would be that there's opportunity in the years that are good, and really that's where we see organizations have success, not in necessarily diversifying their revenue sources, but in having a procedure and process in place to
rainy season fund.
Exactly. It's a management of, it's a recognition when there's a better than average year to not make that the new baseline. And there's a number of tools in sort of the accounting world with commitments and assignments of fund balance that are available options to have either the board or a commission or the, Bert and his team, or the mayor or the city manager to set money aside and say, this money is not to be, just spent. This is built in for in your case, literally a rainy day fund, being that you rely on, seasonal weather. But that's really the biggest thing that we see. As far as diversification and other things, I mean, being that the city is tourist heavy, but you're not reliant on one flow of tourist money. So you have parking, you have hotel, you have said, we have these people, what is the right way to generate revenue from all that we offer? And you have taken a diverse approach in how you do that, to not unfavorably focus in just one area. And for really, that's probably the biggest indicator of success, is having those, and then recognizing when things are above average and making sure that those funds aren't spent without great care.
Bert, you want to add anything to that?
Yeah, I will. And that's always concerned me, and I've always discussed with the city management and commissioners our dependency on property tax. I mean, on non-property tax items. What Bethany Beach did about 5 or 6 years ago, well, it's been longer than that. I don't know whether back in about 2008, 2007, our transfer tax plummeted. It went from about $2 million a year to $1 million, less than $1 million. Well, Bethany Beach doesn't have the broad sources of revenue that we had, so they implemented a 40% increase in property taxes. And I'm not suggesting you do that. That's more of a political discussion. But really, you can't raise these new sources of revenue. You're inflation adjusted, like the hotel taxes. You're going to get your 3%, but you can't raise it beyond 3%. The one tax that probably is going to be considered at budget time is the rental tax. It's currently 6%. Bethany's at 7%. I think will probably be a recommendation to go to 7%.
That's exactly, I was going to mention the rental, which I think has tended to be below what a lot of other neighboring areas had. So you beat me to that. That's exactly what I was going to raise.
We're percentage low on the rental tax. Well, arguably a percentage low. The other thing we did a few years ago is, we doubled the rental tax from, it used to be 3%.
Yeah.
So, but the rainy day fund, I wanted to comment on that. And transfer tax has to be segregated. So essentially where our transfer tax is sitting right now is in U.S. Treasury bills, a big chunk of it. The code is very generous, I guess, as far as using that money. It's restricted money, but Delaware code is very short. There's a few sentences, but we could conceivably release money for certain projects, and the projects that they, capital projects and, I guess certain operating things. But, that would be that's our rainy day fund, and essentially we got $12.5 million in treasury bills, and then there's several million in cash in that. So I kind of regard that as a pretty good rainy day fund. The only thing we don't do, we haven't really shown on our financial statements that money's restricted. But the cash is segregated and it is restricted. So maybe in the future, maybe we ought to. There'll have to be some discussion, but we could certainly designate that in the fund balance section as being restricted for certain purposes.
Okay, thank you.
When was the last time Rehoboth had a financial loss?
Well, I'll tell you, going back many, many years, and this is, I think, pretty interesting history in that back in the 80s, the city got a new sewer plant, and 85% of it was paid for with federal government money. So from day one, that plant was producing cash. So for many years, it was never really, I think the way the budget was done in those days, it never really maybe disclosed it as openly as I think it should have been, but I mean, we were, our general fund was pretty much in deficit for probably most of those years. But the definition of a balanced budget includes all funds. So water and sewer were essentially generating the excess to balance the city's budget. With the new plant, we have to pay for that, and we've got the debt on the books. So the sewer plant going forward is going to be pretty much break even. You'll see that you've got a big change in that position this year, but there's a story behind that in that the county deal made that happen. In the sense that the county loaned the city 48%, they paid 48% of the cost of the new improvements to the plant. And they loaned the city the balance. So the city has debt on their books, but essentially we received an asset at whole value, but we only have 52% of the debt on our books. That helped create that big change in that position. It's not from operating method sources. So going forward, you're not going to see that in next year's financial statement. You know, you're going to see this the sewer fund is probably going to break even, the wastewater fund, and the water fund will produce cash. And it's going to be a challenge this year to balance the general fund to make it balance. You know, it didn't balance this year. It was $1 million in the hole. But like I say, the definition of a balanced budget was all your funds added together. You know, the city could change that definition if they wanted to. They could require the general fund to be balanced, which would introduce a whole new dynamic. But that's where it is. And now, what happened in the last, say, 5 or 6 years when we brought on these new sources of revenue, like the hotel tax, and then we doubled the rental tax from 3% to 6%, and we had a 50% increase in property taxes. That put us pretty ahead on our P&L, so to speak. Now that money's been consumed, there's no way that money's not going to be increased. It's going to be what it is. It's going to be inflation adjusted. As hotel rates go up, we'll get more money. But it seems like we're getting about $1.5 million from the hotel sources, from the hotel taxes, and it's probably going to just move with inflation. Or if you have, you know, higher occupancy, new hotels, I'd say the next big source of revenue that you would have probably going to be the building permit fees to build the new hotels. But there's not going to be any real significant move in property taxes unless they vote to increase them. Parking meters, I don't know how much they can go up this year. So, you know, I don't want to be a forecaster, but I mean, I'm just saying that there are going to be some budgeting challenges this year.
Okay.
Yes, thank you.
Sorry if that was a little too long-winded.
No, not at all.
Never too long-winded when it actually has good information in it. So, but yeah, so to focus just a little more on the entity-wide, so page 19 looks at the assets and the liabilities, and then page 20 looks at the revenues and expenses for the year at the entity-wide level. So this is a little different from the budgetary level because it includes things like depreciation expense on all of your assets, even the governmental assets. And it excludes the principal repayments on your debt, which in your general fund are a budgeted expenditure. But on the entity-wide level, they are just a reduction in a liability. So it's a little different from your budgetary basis, but we'll see the next schedules have the budgetary basis information. But you'll see overall this year, we saw an increase in overall net position of about $14 million. As Bert said, a substantial chunk of that was in the sewer fund and was a result of the contribution from the county. So then, starting on the next page are those fund level statements. and they look at your activity on the same basis that you budget. So it does not include any of your long-term assets, long-term liabilities. So the first thing we look at are the governmental funds, which is your general fund as well as your non-major grant funds. And you'll see at the end of the year, total assets were about 24.5 million compared to about 22.4 million in the prior year. Liabilities were down. The biggest liability is interfund balances. Throughout the year, the general fund is the fund that processes all the payments to vendors. And when revenue comes in, it's passed through the general fund, although it's not recorded there if it's the other fund's money. But this is, so at any point in time, there's money due between the funds based on current inflows and outflows of money. We've been monitoring for a number of years because that number had gotten very high during the wastewater facility construction project. And you'll see here that the due to other funds liability has decreased from 4.2 million to about 1.8 million in the current year. So we're seeing that whittling down back to where we would expect historically. So as a result of that, you'll see the general fund ended the year with about $21 million in fund balance. Part of that is non-spendable because it's either prepaid expenditures or it's inventory on hand, and the remainder is available for the city's use. Page 23 looks at the revenues and expenditures. And these should be consistent with the internal numbers and with your budgetary numbers. You know, the biggest increase this year, charges for services and taxes were actually down a little this year compared to the prior year. As Bert had said, there's regularly fluctuation in the various taxes. There's actually at the back of this document on page 53, a budgetary comparison schedule that breaks down a little more where each tax and each other source of revenue ended up relative to its budgeted amount. And the charges for services, the biggest driver there is your parking meters, parking permits.
Transfer tax is making a decline every year. And we lowered the budget in the FY24 year to 1.2 million, reducing it by 650,000. So we didn't want to get caught in that same situation years ago when they didn't adjust the transfer tax back in 2008 and 9, and all of a sudden the money didn't come in and the city had a pretty big hole in the budget. So we're trying to be conservative on that.
Expenditures increased modestly from the prior year, up to about 18.4 million. Which again, if you look at the budgetary comparison schedule, you can see where the biggest areas are and how it compared with the budget. Excuse me. That did include about $2.5 million in capital outlays, which was relatively consistent with the prior year as part of the city's long-term plan to maintain and continue keeping its assets in good shape. Then the next pages to show you, pages 25 and 26 are the proprietary fund, which is your water and wastewater funds. And I think if we want to flip to page 26, I think that's probably worth highlighting. As Bert mentioned, the sewer fund saw an increase of about 6.2 million. 6.1 million of that was the capital contribution from the county. The other thing to highlight with the water and sewer fund is, like with the entity-wide financial statements, the revenues and expenses you see here do not reflect the repayment of principal on loans because it's a reduction in a liability. So as those principal payments continue, it's worth keeping an eye not just on the net change in net position number here, your revenues less expenses, but also on cash and investment balances. Because when you're repaying debt, it's possible to have a year in which you show a profit on this page, but your cash is going down. So it's just another thing to keep an eye for and just something to look at on this report. Did you have anything you wanted to add on that, Bert?
Yeah, just a brief summary. The business debt between this year and the prior year increased by $3.7 million. And most of that, or well, all of it really was due to the county loans. There were 3 loans that we extended from the county. So that's why you have that increase in the business debt. On the government side, it went down by $1,087,000. And basically, we have a loan with JP Morgan Chase, and we're just amortizing it. And so that's why it's going down. That loan, by the way, is at 1.6%. So,
Any of your loans have subject
think-
to interest rate risk?
I'm
No.
sorry, would you be able to, I think Mr. Horty needs to be reconnected. Is he calling back? I think we need to answer.
you there? Hello? Did you get cut off?
He'll probably call back and get in a second. You might just want to keep an eye out for him.
No, that was one of my goals, is to lock the debt down. Now, the outfall debt is through the state DNREC funds, and that debt's at 2%, and it's fixed for the whole term. I think it expires. There's a $12 million piece that was for the plant, and I think it matures earlier than the outfall debt. I believe the outfall debt, I think it's 2043, if I'm not mistaken. So we're locked in at 2% for the duration. And the only thing we had above 2% was the School View sewer. They had a problem out there with the sewer lines about 10 years ago, and we took out $450,000. It was paid off on November 1st, so that's gone away. So all our debt is fixed at 2% for the duration, or the 1.6%. So now if we have to go back to the market, we got a problem.
Yeah, I think you locked in at a wonderful time. We did, unfortunately. And I think we tried to call each other back at the same time.
But citywide, the amount of debt increased by $2.68 million.
Okay, we got you back.
All right. So at this point, I guess I'd really like to open it up to any other questions. The one other thing I was going to draw your attention to is page 39, which has the new note disclosure on leases. But I really want to make this meeting as useful to you as possible. So I'd really like to open it up to any questions that anybody may have about the financial statements, about the audit process, or about anything else that I could touch on.
I'll start. This is to Bert. On page 34, we talk about the cash and cash equivalents, and there's a paragraph there on funds held at SIPC insured institutions, that's SPIC. That has a very low limit, like the FDIC does as well. So it's just sort of really a question whether, where we keep our eye on that, and B, whether we have any special arrangements the way we do at the bank with the government notes.
Well, that's a good question, because I had the same question when I did this. And that the SPIC insurance, from the explanation I got, is mainly for improper use on the part of the firm mishandling funds. As far as our assets, they're essentially an asset those assets are not commingled with anything that Edward Jones or Merrill Lynch or any other firm has. So there's basically an asset and a liability on their books. And unless somebody's really dishonest, I don't see, if the firm failed, I think is what you're really thinking about.
What I'm thinking about, Bert, is you're absolutely correct. You know, SIPC is against fraud, but if you think about it, for many of us, we will have, let's say you have an account at Schwab, and you have your investments in Apple and everything else, and then you have cash. And the cash is basically a liability of, in that case, Schwab, if you have it in their money market fund or whatever. And you know, I was a bankruptcy lawyer in my prior life, so that's why I'm always here with gloom and doom, because that's the way I think. So I just really wanted to highlight that we should keep an eye on those excess cash that we may have at any brokerage house and be aware of what they're doing with it. In some cases, they're putting it in government-insured funds. Some cases, it's just basically a money market fund that they're running. And in 2008, there was a risk with some of those money market funds that if they had to liquidate their holding, they would have taken a loss, which is why the government stepped in the financial crisis. But there's no guarantee that they would with respect to any particular brokerage house.
Yeah. Well, as far as the cash that's in those funds, it's very little because I try to invest. You know, it's basically whatever we can't buy $1,000 of, because the T-bills are now down. It used to be when I bought them many years ago, they were $10,000. It was a minimum. Now you can buy $1,000. So apparently, I mean, I have the state. Probably what would help you is if I showed you the monthly statements that we get. But basically, there's very little cash there. You're talking probably less than $10,000 in all three. You know, and I think more like less than 5,000. So I think we're okay.
Okay, I just wanted to highlight it
It's a good point.
when I saw it.
Yeah, it's a great point. I had, and I don't, I do think, off the top of my head, that cash may be insured, but, you know, because they sweep it into a bank account, I believe.
Yeah, I would say a lot of the brokerage houses have, like Schwab has a bank.
Yeah, right.
For that purpose.
That's right.
And then you're going to be keyed to the $250,000 insurance. And so the dollars you're talking about would be covered if you end up with a lot more than that you know, you sold some a security and it's just sitting there. And, you know, the risk we saw with Silicon Valley Bank is that bank really collapsed in about 4 days, literally. And so I just wanted to, when I saw it, just to raise it with you.
Yeah. Point well taken.
And then the only other question I had is we do refer, I think, on page 52 to donations that the city makes, you know, fire department and elsewhere. Do we have an actual policy on how the city determines, you know, A, you know, what organizations to support, and B, if I recall correctly, I saw some numbers in terms of how our donation to the fire company, and I'm a big proponent of organizations like our fire company, you know, is way higher than either Henlopen Acres or North Shores were paying, where I think one of them was paying almost nothing and the other was paying a very small amount of money. And just simply as a Rehoboth Beach taxpayer, I sort of want to raise the question about A, what our policy is, and B, whether we have discussions with those neighboring jurisdictions about who's bearing what a portion of support.
Well, I've heard Chuck Snyder speak at length on this issue. Chuck is I don't know whether he's a chief of the fire company, but he's been involved with the fire company ever since he was a teenager. And one thing he points out is the fire company serves not only these entities, North Shores, Rehoboth, and Dewey Beach, but they cover all the way down to the inlet and all the way out on 24. So there's a big area, the unincorporated area, that doesn't probably get anything to the city. And I think in recent years, I mean, it's been brought up that Henlopen Acres pays very little, and Dewey Beach, I think, has added an ad valorem tax for the fire company, or maybe maybe they're just donations. I don't know for sure, but I know that they're putting a little more pressure on the citizenry somehow to go ahead and contribute more to the city. I don't think it's a lot. It's not anything close to $100,000, but yes, it'd be nice if you know. And I don't know what North Shores puts in. I have no idea what comes through there, but
I've seen the numbers. It's way, way less than what Rehoboth Beach is paying, and so you know, all I can do in my current role is encourage the city leadership and the commissioners to voice the point that we're all benefiting from these group of volunteers. The costs are just going up tremendously. Everything from gasoline to healthcare and everything else, and then simply as a matter of equity, trying to urge those groups to contribute along the lines of the way the city of Rehoboth Beach is would be something I think would be well advised to try to do.
well, I think people are getting more vocal about this because this has been something that's been discussed for many, many years, the lack of contributions.
Yeah.
And even to compound the problem is when Rehoboth was a sleepy little resort town, there was nothing else to do in the 1960s except join the fire company. And that pretty much came out of the mouth of Howard Blizzard, because all the young guys joined the fire company. Well, now there aren't any of those. And the number of members in the Rehoboth Fire Company who live within city limits, I think is 2, and maybe less, I don't know. But there aren't many members. And of course, that's one of the reasons you have the fire station out on the highway, because members are living out there. So, and this is a nationwide problem, getting members to join fire companies. So I guess where it ends up is we could eventually have paid members, and we do have some paid members for the ambulance services, but
if we end up having to do more of that, then it becomes even more so that the other jurisdictions need to contribute, because it's simply not right for the taxpayers in Rehoboth to be bearing the cost for these other jurisdictions. They really should share it.
absolutely.
I know I'm talking to the
Yeah,
committee.
but I think it's good that, and I think, it's good that more people are talking about that, because I think a lot of people living in Henlopen Acres or Dewey Beach probably weren't even aware of what the contribution was. So,
Good. Well, thank you.
Jeff, just on that one note, you may want to check the Rehoboth Beach Public Library.
Yep,
Should be
I saw it when you did. Yeah.
And you're going to keep the 75 going to the library, considering they're,
well, it won't be my decision, but I would think that the commissioners, if I had to guess, I'd say they're going to reduce it, because they got their COVID money and they went out and built a new place out here. They're going to build a new place out on Warren Road, I guess. So we don't have as big a facility to support here in town. So you would think that the commissioners will reduce that. Used to be, for years, we gave them $12,000 a year. And the Historical Society has been getting about the same thing, about around 20, 25,000 over the years. But you're talking about the process that we use to decide how we're going to get these donations. And that's kind of interesting, because it used to be they sent letters in. And in recent years, they've had the representatives from these organizations come in and make a presentation. And I think the commissioners decided they consumed a tremendous amount of budget time for $335,000. So I think there's going to be a formal application process, and I would say any 501c3 probably could apply, but historically we've supported the the fire company, the Historical Society, library, and Main Street. And, you know, the Main Street contribution, I think Main Street does a lot of good things for the businesses, but it is a little different than the other two, and that is sort of a special interest group. It doesn't represent, it represents the business interests. And, but I think that that's not to say we shouldn't support Main Street. I just want to make a distinction between what they do. Anybody can go to the library, and anybody can go to the Historical Society. And, but, so I would say we'll probably just have those 4 organizations applying, but you never know.
Just have one. Do you have a succession plan?
Yeah, it's called Live a Few More Years. Actually, you know, this is my second career. I was in the private sector for 25 years, and I didn't really become an employee of the city until 2018. But I think you might be able to connect with this, Jim, a little better. And that people have asked me about this, how long does it take somebody to get up and running on being a finance director? Well, you and I know if an accountant is a good accountant, he knows how to keep books, and he knows how financial statements ought to be prepared. So, you know, he may have to come in and learn how to punch the buttons on the computer and get familiar with some of the unique things that we have here. But I think a good accountant can come in fairly quickly. And so I think when they do, I'm hoping to, you know, still be around. I think I would aid in that transition, but I'm hoping to stay around a few more years. And
I don't want you going anywhere. I'm
Yeah.
just,
I'm a young 72, but you know, not to get on a pedestal, but I mean, the town's been good to me over the years. I've been here on and off for most of my 72 years, so it's a kind of a pleasure to serve too.
good.
Okay. Anything, Bert, Jeff, that you want to add?
No, I think we had a good year, but we're going to have to be careful going forward.
Is that largely because of the transfer tax falling off, or
Well,
the combination of that and
I
the
think
costs going up?
My biggest concern going forward is the capital requirements. They have a 5-year capital plan, and it's in our budget. Our budget is on the website. You probably have seen that. It's under, if you go to the City of Rehoboth, and then you go to the Gov tab, under that, the budget's there for 2024. We did win a budget award again this year from GFOA. But I think that in there's a capital budget, and it's enormous going forward. And so if I have a fear, that's the fear. I mean, are we going to be able, I mean, this city supported in 2024 a $10 million capital budget. That's the largest we've ever had in years, say, starting around 2007 and 8. Those capital budgets were $1 million to $3 million. And if the requirements for, you know, different projects, they're talking about Baltimore Avenue and Wilmington Avenue as projects, unless there's grant money out there, which is where most of the streetscape project from Rehoboth Avenue done back in the early 2000s, most of that was paid for with grant money. And unless there's grant money out there, these projects will either have to be postponed or reprioritized. But that's the demand on for capital projects, my big concern. I mean, right now, we have the kind of balance sheet where we have a cash balance that everybody would, you know, envy, you know, for a town this size. You know, you're talking over $40 million in cash, but you guys have been in business before, and you know when you've got big capital projects, that money can go a lot quicker than people realize. So being vigilant and doing the best job we can on managing these capital plans, I think is the most important thing right now.
You know, are there potential grant sources that we are looking at for things like Baltimore Avenue?
Well, I was in on a meeting where they presented a presentation, and at that particular meeting, they were talking $60 million. Well, you know right away that when you have $15 million left in borrowing capacity, well, less than that. I mean, we're talking debt of 75 million is our limit, and we've already borrowed for these other projects. Right now, as of end of March, it was 62 million. So you don't have a lot of borrowing capacity unless there's a referendum to borrow more money. And then, but then you got to service that debt, and you can't, and you got to service that debt with real money. So there's challenges, but I think we'll be smart enough when we put the budget together. We're gonna present to commissioners with a balanced budget, and if they want to raise additional revenue, it'll have to be discussed.
Jim Hardy, is there anything you wanted to add before we close this?
No, I'm fine. Jimmy?
Yeah, go ahead.
I'm fine.
Okay,
Good
great,
meeting.
thank you. All right, why don't we close the record on the discussion, and I will make a motion that we approve the audit as presented and presented to the city commissioners.
Second?
Okay, I'm in favor?
Yeah.
And you're in favor? Okay, so that's a unanimous vote to approve the audit and present it to the commissioners, and we thank both of you for your hard work on this and for the presentation.
Thank you for having me out this afternoon and for putting your trust in our organization.
Well,
It's always a
thank
pleasure
you.
to see you both.
Well, and I really thank you for taking the in-depth look at everything. I think you probably know our position by looking at this audit report better than almost any citizen in the town. So we need somebody like that.
So, we both enjoy doing it, and we both appreciate all the work that the city staff does. You know, it really is quite remarkable for a town of this size. I think we punch above our weight in almost everything that we do. So I think it's a pleasure working with you folks.
We try hard.
Thanks.